$479,000. That is the average amount of money a person silently transfers to banks, lenders, and financial institutions over the course of their lifetime. Not through fraud, not through crime, through the exact system you were told to trust. Here's the thing nobody tells you. That number isn't a mistake. It isn't bad luck. It is the designed outcome of a system that most people never question, because they were never taught to. Not in school, not at home, not anywhere. And by the end of this video, you will understand 3 things the financial industry hopes you never connect. And once you see it, you cannot unsee it. Let me ask you something. When you were growing up, who taught you about money? If you're like most people, the honest answer is nobody. You learned how to solve for X, you learned the dates of wars, you maybe learned how to dissect a frog. But how interest compounds against you, how inflation quietly erodes every dollar you save, how the gap between people who build wealth and people who just work actually works? Nothing. Silence. A blank page. And that is not a coincidence. The less you understand about money, the more predictable you become. And predictable people are very, very profitable. Today we are going to cover 3 specific mechanisms. 3 ways the financial system extracts wealth from people who never learned the rules of the game. The first one affects almost everyone. The second one affects everyone. And the third is the one that separates the people who eventually escape this cycle from those who never do. Mechanism number 1. Interest. Not the boring definition, but the real impact. The average person carries $6,000 in credit card debt. At a typical interest rate of 22%, they are paying roughly $1,320 every single year just to stand still. Not to reduce the debt, just to maintain it. Now add a mortgage. The average 30-year mortgage on a median home means paying back roughly double what you borrowed. You buy a $300,000 house. You hand the bank $560,000 by the time you're done. That extra $260,000? Pure profit for them, not for you. And here is the part that should make you stop and think. None of this is hidden in fine print. It is all disclosed, it is completely legal, and the reason most people never calculate it is because nobody ever encouraged them to. Knowing this number is uncomfortable, not knowing it is expensive. Even if you have never borrowed a dollar in your life, there is a second mechanism running in the background right now, every single day. In 2020, you could fill a grocery cart for $150. Today, that same cart cost you closer to $220. The groceries didn't get better, the food didn't change. Your money just became worth less. This is inflation, and inflation is essentially a tax that nobody voted on. When governments need money, they can print more of it. More money chasing the same number of goods means each dollar buys less. Your savings account holds the same number, but it represents less real value than it did last year. The average inflation rate over the last decade has been around 3.8% per year. That means money sitting in a traditional savings account paying 0.5% interest is effectively losing value every single year. You are not saving, you are slowly losing in slow motion. And who benefits from inflation? Not the person with savings, not the person with a salary. The people who benefit are the ones who own assets. Real estate, stocks, businesses, because those assets rise in value with inflation. While cash loses purchasing power, assets gain it. The game is not rigged against working hard. The game is rigged against holding cash while others hold assets. But have you ever actually calculated how much your savings account is losing in real value each year? Drop your answer in the comments below, because the number shocks most people when they see it for the first time. Now, what we are about to cover next is the part banks genuinely hope you skip. If you want to make sure you catch the rest of this series, hit subscribe right now, because next week we go even deeper into exactly how credit card companies engineer debt cycles on purpose. But first, let's talk about the one shift that separates people who build wealth from people who just generate it for everyone else. Meet 2 people. Same age, 25, same starting salary, $45,000 a year. Person A does what they were told, works hard, saves money in a savings account, buys things they enjoy, lives a comfortable life. Person B does something slightly different. They learn one concept, assets versus liabilities, and it changes every decision they make for the next 20 years. An asset is something that puts money into your pocket. A liability is something that takes money out. A house you live in is a liability because it costs you money every month. A house you rent out is an asset because it pays you every month. A new car is a liability because it loses value the moment you drive it off the lot. Shares in a company that pays dividends are an asset because they generate income while you sleep. Person A and Person B. 20 years pass. Person A has worked hard, paid their bills, lived their life. They have savings, maybe some equity in a house. They are not poor, but they are still working because they have to be. Person B has used the same income to gradually acquire assets, income-producing assets. Their money now makes money, and they have options. Person A does not. Same starting line, different outcomes. The only variable was the question they asked about every dollar. Is this an asset or a liability? The system isn't broken. It's working exactly as designed, just not for most people. Yet. So let's bring it back to that number from the beginning. $479,000. Interest compounds against you. That is mechanism 1. Inflation erodes your savings silently. That is mechanism 2. And staying on the liability side of the equation keeps you working forever. That is mechanism 3. None of these mechanisms are secret. They are just never explained in plain language to ordinary people at the moment when it would actually matter. Which is exactly why most people spend their entire working lives generating wealth, just not for themselves. But here is what you now know that most people do not. You know that debt has a real calculated cost and you can calculate it. You know that your savings account is not protecting your money, it is slowly surrendering it. And you know that the single most important financial question is not how much you earn. It is what your money is doing while you are not looking. You cannot control the system, but you can understand it. And understanding it is where everything changes. Now you know, and most people never will. Quick question before we go. Drop it in the comments. Did anyone ever teach you about money growing up? Yes or no, because the answers are always fascinating, and I read every single one. Next week, we go inside the credit card industry. Not the surface level explanation, but the actual business model. How they engineer the minimum payment, why the interest structure is designed exactly the way it is, and how a $500 purchase can end up costing you $1,200. Subscribe if you don't want to miss it, and share this video with one person who you think needs to hear it.